Welcome to the PPOB meeting. Remind everyone to please silence your phones, and we will, Madam Chair, listen to me. Madam Clerk, but we have a quorum, but so you please call the roll.
Senator Chambers Armstrong. Senator Elkins.
Present.
Senator Funky Fromar. Present. Senator McDaniel. Senator Neal. Senator Nemus.
Present.
Senator Wilson. Representative Bojanowski. Representative Camuel.
Here.
Representative Duval. Representative Fleming. Representative Johnson.
Here.
Representative Petrie.
Here.
Representative Tipton.
Here.
Auditor Ball.
Here by proxy.
John Hicks. Victor Maddox. Here. Sharon Mattingly. Representative Hale.
Present.
Senator Higdon.
Here.
Representative Thomas.
Present.
We do have a quorum, so we're ready to get started. We'll start off as a tradition in PPOB since Representative Thomas became the co-chair. We'll do the Pledge of Allegiance and say a brief prayer. Representative Hale will lead us in the prayer. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Representative Hale.
Bow our heads, please. Father in heaven, we thank you today for allowing us to gather here. We thank you for all the members that are here with us. We thank you for blessing us to arrive here safely. We pray that you bless this meeting as we conduct business here today for this great state that we live in. We thank you for giving us the opportunity to serve our people around this great commonwealth. We thank you for every blessing in each one of our lives. Now again, bless this meeting today, and we'll lift up that wonderful, most precious name there is, the name above all names, Jesus Christ. And we give you the praise in Jesus' name. Amen.
Amen. Okay, at this time, we'll entertain a motion to approve the minutes from the last meeting. We have a motion and a second. All in favor signify by saying aye. Aye. Opposed? Ayes have it. The minutes are approved. Our first order of business today is Bo Craycraft with Judicial Forum Retirement System. And Bo, if introduce yourself for the record, and the floor is yours.
Awesome. Thank you for having me today. My name is Bo Craycraft, and I'm the Executive Director of the Judicial Forum Retirement System. It's good to be here this afternoon, and I appreciate the opportunity to share a little bit about our agency, and appreciate your time. I was asked this afternoon to provide a quick update on three things. First,
Bo, let me interrupt you. You're not received real well here today because my head staff member here says that your team beat his team, and that you weren't very nice to him.
That may be true. Not the not nice part.
Okay. Well, Brad shared that information with me, so you can blame him. So
I had better players. They have a better coach.
Oh, sucking up. Please proceed.
No, it's good to be here. And again, just asked to share quickly on three things. First, investment performance and asset allocation through the end of the fiscal year. A summary of cash flow as compared to the previous fiscal year. And then lastly, we've been asked to provide some preliminary estimates with regards to projected employer cost, as well as some recent trend over the past 10 years with regards to employer contributions. And so with that, I'll get started quickly on slide 2, which is investment performance. This represents, again, the end of the fiscal year, June 30, 2025. And for the fourth fiscal year out of the last 5, both LRP and JRP have posted performance that not only was able to exceed their actuarial assumed rate of return, but also their blended performance index. So that's great news. If you look starting on the short term with the 1-year return, you can see that the portfolios, they had a tremendous year, not only in absolute terms, but also relative to their benchmark. And, in years past, we've had positive numbers, and I've told you all that a lot of what worked for us is that we had more of the stuff that did well. We're highly allocated to U.S. equity, and we'll see that on the next slide. And over the past couple of years, equity markets have just continued to just perform very well. And that was the case this year. The S&P 500 was up 15%. However, much of this outperformance relative to benchmark is really due to the individual stock selection from Baird Trust. Their U.S. equity portfolio outperformed the index by 11%. So they earned 26% on the equity side relative to an index of 15. And so it wasn't just a case of us having more of what worked. It was a combination of having a lot of what worked, but also individual stocks that performed better than the index. And so just wanted to make sure that I highlighted, Baird Trust is a talented group of equity investors, and so they deserve the credit. As you move out across longer time frames, again, the plans have provided solid performance. If you look out at the 30-year number, it's a little over 9.5%, and that's 9.5% a year for 30 years, net of fees. And if you look, I always like to look at the 5-year number. It's a little short term in the sense of investing, but it's significant from an actuarial valuation standpoint. And how we recognize gains, and you can see that the return for the 5-year period is 14% annualized. Slide 3 is a quick snapshot of asset allocation. Just as a reminder, we have an investment policy statement that targets 70% U.S. equity. It's all large cap, domestic, and then 30% is allocated to the intermediate government credit bond market. And I actually went back this morning and took a snapshot of like the last 3 fiscal years, and this slide has actually stayed pretty stable over the last 3 years. Baird has really, it's twofold. Number one, I think it's a sign of kind of where they think valuations are on the U.S. equity market, but also I just told you we earned 26% on the equity side, but the bond portfolio produced a 7% annual number. So there's some opportunity there. And those two things kind of have combined. And so they've really rebalanced the portfolio about any time we got close to 75% equity. They usually take it back close to 70, and then, the equity markets have been successful. And so that kind of has repeated itself. But they've tried to stay somewhere around that 70 to 72% equity allocation. And so they were pretty spot on as of June 30. They actually have rebalanced since June 30, which of course isn't reflected, but in early July, they rebalanced once more. Slide 4 is just a snapshot of cash flow for the 2 most recently closed fiscal years. There's not a lot here specifically that I want to draw your attention to, but I did want to highlight just a couple of things. First, with regards to the cash inflows, you can see that investment income, it increased pretty dramatically. It's a little misleading, to be honest with you. Some of that is due to the higher bond yields that we're receiving, and so we did receive quite a bit more in bond proceeds. But the majority of that difference is due to some non-cash activity that occurred with regards to General Electric. General Electric, they kind of broke what we know as General Electric into 3 separate companies, and so there was some accounting, and that's really stuff that happened in 2024 that's kind of bled over to 2025. And so we got all these spinoffs and we got shares of those new companies. And so from an accounting perspective, it's a little wonky. Outflows were pretty stable. There was a slight increase, which was driven largely by a slight increase in benefit payments, but nothing dramatic there. And as you can see, and as has been the case for several years, really since I've been here, outflows outweighed inflows. And so we are in a negative cash flow position. And I think a couple of fiscal years, we started adding this net cash flow ratio just so you guys could get an idea of kind of where we're at from a negative cash flow standpoint. And I know you all have heard testimony that, from actuaries that, somewhere around that -1% to 5% is generally manageable. With regards to our plan, it's going to be driven largely by our investment gain losses, right? Because we're we're calculating this using a planned net asset value. And our planned net, like this year, our planned net assets went up, $100 million because of the asset gains and unrealized and realized. In the future, if we have a negative year, that cash flow, ratio is going to go up. But despite the negative cash flow, again, entirely driven by the strong investment results, you can see that both the plans had a net increase in plan assets. JRP is almost at $750 million, which is just crazy for me to think about, and LRP is just under 220. So combined, they're just under $1 billion. And so again, when you look at those investment returns, 14% a year over 5 years, that number is going to grow. With that, I was going to just pause real quickly. That's kind of the conclusion of the financial investment side. I've got 2 quick slides on the budget, but wanted to pause and see if there's any questions with regards to the financial information.
Chairman Thomas.
Thank you. Appreciate this. So in 2014, we implemented the cash balance plan. Mm-hmm. Do you have kind of the interest credit or rough idea of how that did or so?
Yeah, our interest credit this year is right around 11.4%. One plan is like 11.42, and I think one plan was 11.47. And again, that's calculated based off a trailing 5-year number. And if you look back at the so we've accounted for the assets separately. That was a decision the board made back in 2014 when the plans were created. So we calculate it based off that cash balance number. So if you look at that 5-year number is roughly 14%. There's 4% is guaranteed, and then the member gets 75% of the difference. The difference is roughly 7.5%, and so 7.5 plus 4 would be 11.5. Yeah. Thank you. All right, with that, then we will real quickly. I was asked again to provide preliminary estimates with regards to employer contributions. Before we get to the numbers, I've included slide 5, which is a summary of a recently completed experience study. As you all know, we are required by statute to complete a full actuarial experience study every 5 years. The most recent was dated back to 2020, so in 2025 we have updated that. GRS, who became our actuary about a year ago, conducted this, and they have suggested a few. None of them are very material. Minor changes to a handful of our assumptions, and the board approved those in August. So I just wanted to kind of provide this information because when we look at the projected employer costs, it did increase a little bit relative to where it was, and mostly due to these changes. I've included 5 basic assumptions that changed here, but really the only one to make note of is the individual salary increase assumption. That is driving almost all of the increase in the liability. And this has been a tough assumption for our board, really probably dating back 15 years, because our members, whether they're legislative or judges, the increments have been really like start and stop, right? There'll be long periods of time where there were no increments given, and then there's kind of like these catch-ups or these short periods of time where you kind of have significant increases. And so depending on the period, 2 years ago, we were in the midst of kind of a short-term period where judges have been given a couple raises and legislators as well, and the board kind of waited until this full funding of experience study. And so GRS has basically tried to simplify it. We had this tiered approach where like first 5 years, the assumption was super low, and then it kind of ramped up over time. And that was leading to some negative actuarial losses in periods like we're experiencing now. And so they've kind of split the difference. And so they've gone to a fixed growth rate for the entire assumption, and it's 3%, but which is a little bit lower than what we've experienced over the last 5 to 7 years, but a little bit higher than the 10-year. And I think GRS's point of view too is that this is an assumption that we're required to look at every other year, not just every 5 years. And so we can take kind of shorter term looks on this and maybe make modest changes, valuation to valuation, instead of, this is a fairly significant change because we had kind of a tiered approach. and we're kind of trying to catch up. And so that's really it with regards to the assumption changes that had any material impact. The only other one I'll introduce is the cash balance interest credit rate. That was something that was a recommendation from the PPOB audit that Milliman conducted. This is our first funding valuation since that audit was completed, and so the board did adopt a higher interest credit. And what this really means is this is what we're assuming that our cash balance members are getting with regards to that hybrid interest credit. Historically, it had been the guaranteed 4, but actual experience has been higher than that. And so it doesn't really impact the plans now because the liability is so small. But as those cash balance memberships grow and the assets grow, this will have a slightly some more significant impact.
Senator Fromeyer has a question.
Yes.
Thank you, Bo. This is so interesting. Mortality indicating that there's a small increase in liability. What was the anticipated age of death and the one now being used?
I can't tell you the exact age that they were assuming. Women are assumed to live a little bit longer than men.
We do live forever.
And so the way these things work is you have a schedule as of today, which is the table, and then they have what is called projection scales. And so the projection scales then they kind of calculate over time. So somebody today is expected to live till 80, but in 2035 that same person will probably, with medical advances, maybe it's 80 and a half, And so they're projecting out kind of longer term, and that's called an improvement scale. And so I would say, and I can definitely follow up via email with our exact numbers. I think it's women are somewhere around high 70s, right around 80. Men are a few years younger than that. And then this projection scale, it was like it increased about half a year across the board, whether it was male or female, when you look out, And so the increase in liability, we're assuming that you all are living a little bit longer, but not enough to really materially impact the liability at a total level.
I'm very surprised to hear that. I'm in that business a bit, and the 5 years from 2020 to the present, we've declined in mortality.
Well, these things lag too, right? So a table that is published in 2020 is probably not using data from 2020, right?
Right.
Because these things
25 would be using some very interesting data.
Yeah, and I think you
20
have
to 25.
I'm not an actuary, so I don't claim to have any knowledge here. But I do know that they're kind of slow to adopt, and so they want everything to be smooth. That's why we smooth asset gains, and so I do think that the growth has definitely declined, but you haven't seen kind of a reversion to age just yet.
And I appreciate that this is a more conservative measurement, so I'm okay with that.
Right. The other difference I'll note is if you have a similar conversation with folks at TRS or KPPA, they have big enough groups that they're calculating mortality based off their group. KPPA is 300,000 members, right? And so they can look at actual experience from their membership. Given that our group is a little bit smaller, we don't do that. And the groups that we're using with regards to these mortality tables, they are considered to be above average as far as income, which gives them more access. And so they generally, live a little bit longer than someone who doesn't have the same level of access to care or ability to get care. Does that make sense?
Mm-hmm. It does. Thank you.
Yeah.
Thanks.
Representative Johnson has a question.
Thank you, Mr. Chairman. Real quick. We're seeing that these changes in the experience study is impacting the liability. Is this 100% of the impact on liability, or are there any factors we maybe should know about other than these that might be impacting liability?
I don't think there's anything else. And what I really probably should say is most of these changes are really impacts on normal cost, not really a liability. Now, what's happening is you're recognizing some additional liability because we've changed from where we were in 2023. But what really is happening is judges are making more, legislators are making more than they were 5 years ago. And so now we're going to pay them more in retirement benefits. And so that increases the normal costs. They're living a little bit longer than we expected them to live. And then again, the other thing here is like on the cash balance side, we were assuming they were going to get 4% this year. They're going to get 11, right? So you're adding some liability, but there's, again, net, and I'll just go to the next slide so you can see, our contribution this year was set at 700 grand. The projected for 2027 is 2 million. And what I'll say is that these numbers don't include any investment gain losses that will be recognized since 2023. So these are kind of like probably as high as they would go, and they're definitely conservative because we just looked at investment returns. We're definitely going to have gains to recognize. I just don't know at what impact. And so with these preliminary estimates, what we do is we look at the 2023 valuation and we kind of roll it forward and we change the assumptions so that we could see the difference. And then when we get the 2025 valuations, we'll get an actual projected employer number. And I do expect it to be less than this. I just don't know how much of those gains will offset the increase in the liability from those small adjustments to the assumptions.
It would not be a bad thing if we had a pleasant surprise for once, so that would be okay.
Yeah, no, I definitely am confident that it will go down because, again, we should have additional gains. But I don't know the other experience too, right? Salaries have gone up, so our payroll may be a little bit higher. There's a lot of moving parts, and again, I don't claim to be an actuary or have even stayed overnight at a Holiday Inn Express. So,
All right, thank you very much. Thank you, Mr. Chairman.
Please proceed.
yeah, with that, the only other thing we included was the long-term trends, and again, you can see from where we were last budget to this budget, there is a slight increase. Most of that is due to the increase in the normal cost that is currently projected with regards to those assumption changes. And the other aspect is, the funds have been fully funded. They do have some surplus assets, but much like unfunded liability, the way our funding policy is set, they only recognize a portion of that. Just like we only recognize a portion of a loss or a unfunded liability, and we spread that over a closed period of 20 or 30 years, the gains are treated exactly the same. So that's why there's still a small employer recommended contribution.
Representative Tipton has a question.
Thank you, Mr. Chair. Bo, on this last slide, the employer cost in the judicial plan goes up drastically from fiscal year 26 to 27, 28. Could you elaborate a little more about what specifically is causing that?
Yeah, that's completely being driven by those assumption changes. And again, that 2 million is based off a 2023 valuation as far as demographics are concerned. We just, so we were projected to be hopefully close to zero, right? That was the goal. But those assumption changes have added some liability, which, has increased the employer contribution. I expect when we recognize gains from the 2025 valuation that it'll come down. I don't know if it'll get below the point, the 700,000. Probably won't offset it completely, but should be somewhere below what you're seeing here. But it's all completely driven. Nothing else has changed as far as the plan is concerned.
Bo, I do have a question for you, and we'll just ask you to share the information that about the Medicaid Advantage plans as we talk about insurance with the other plans, and the drastic increase that we saw with the judicial legislative plan. Could you share that information with everyone so we kind of know what's maybe, I don't know if that's a trend that you ran into or something not to worry about, but it is interesting.
Yeah, and I think what you're referencing to is for the 2025 plan year, which we're currently in the midst of. As a result of several changes, most notably to Part D, we saw significant increases in our Medicare Advantage premiums. Most of it was driven, again, by the Inflation Reduction Act that was passed several years ago, and they've been phasing in. But on the Part D, there was kind of some new guidelines set by Medicare. They were all positive for the member or the participant, right? It was an Inflation Reduction Act, but you reduce inflation somewhere, it goes somewhere else, right? And so it came to the plan. And so our premiums did increase dramatically last year. around 45%. I can say this year that has not been the case. Our premiums are slated to grow somewhere less than 5%, which is kind of consistent with kind of what we're, everything feels like it's 3 to 5% more. And so I think that's going to be more of a one-time thing. It was clearly not the easiest to stomach as far as the amount. And I think that's going to be something interesting to see with our 2025 valuations. Our health insurance plans, and I know, across multiple of the pension administrators, you've seen really positive results on the health insurance side. And our plan is small, and so the funding level has gotten really high at times. But I think this, the Medicare premiums going up are gonna definitely probably detract a little bit from the funding level, even with the investment results that we've gotten. Because again, we're projecting paying those premiums for folks until they pass away. So 20, 30 years in some cases.
Okay. Thank you, Bo. Seeing no further questions.
Appreciate the time.
Appreciate you being here. And next time, be easy on Brad, if you would. He's been in a bad mood all day. Next up, we have Ryan Barrow with KPPA. Y'all get the usual announcement. Please identify yourself for the record, and the floor is yours.
Yes, Ryan Barrow, Executive Director, KPPA.
Hi, Erin Surratt, Executive Director of the Office of Benefits at KPPA.
Appreciate the opportunity to speak today. We come bearing good news, particularly on the investment side. All our funds for the fiscal year exceeded the actuarial assumed rate of return. That's always important. As Bo talked about, when you exceed that will have positive impacts on the plan going forward. And that those excess earnings will be amortized, a 5-year smoothing. So we still have some previous 5 years performance that exceeded it, and we'll add to that with this. In terms of the benchmark, all pension funds exceeded their respective benchmarks. We've talked a little bit about some of those. There's some work being done to change a couple, but the benchmarks were exceeded. Sharp ratio, which is a measurement that it accounts for risk, over the 1, 3, and the 5-year periods, top decile, so top 10%. That's something that we monitor and report to the boards. And it's certainly a positive thing, adjusted for risk. In terms of the cash flow, net contributions across all plans were positive. There's a little bit of caveats we're going to talk on the insurance side that Aaron will address. In April, we talked about the board's changes in 2024 related to asset allocation. That isn't something that you immediately sell in a position and buy into a new to rebalance. You do that over time. That process has been complete. So all asset allocations are within the board-approved ranges. Two other things that we're happy about that I just added to the slide. Been a major initiative across the agency to reduce accounts receivables for employers and those monies that were owed to us. That's been very successful. We'll continue down that path, and we are able to add another individual, kind of a junior, to our investment team, which we're a small investment team, but very efficient. I put in a slide here, just again, the market was very strong over the last year for the reporting as of June 30th. Really, almost every asset class performed absent the dollar and oil across that, and that's experienced in our performance results. So on the Ks, state police, CRS, non-haz, and hazardous plans, double-digit returns. As I said, they exceed the benchmark. On the 1 year, going to the right side of the chart, essentially at or right around all of those over the longer term. And that is in excess, all those performance numbers are in excess of the assumed rate of return, which again, just has a positive long-term economic impact on the fund. Switching over into the investment returns, similar story here. The double-digit returns, the 1 year essentially at or exceeded, and same with the 30-year. So positive performance numbers really on both the pension and the insurance side for all the various plans. This is the summary of the asset allocation. As I mentioned, in April, we talked about this. It was a multi-month, multi-quarter process. Your biggest impact really is your asset allocation. That directly correlates to your performance as well as your risk. So within board-approved ranges, with the largest investments really being public equity, specialty credit, and our kind of core fixed income, so bonds. Wanted to kind of move into the cash flows, the old formula, contributions plus investment earnings equals benefits plus expenses. So looking at, I won't read any of the numbers here, but we've built the sheet as you've seen before, the blue with the contributions that essentially flow in. You have interest earnings on your account balances. Then we have the contribution outflows. So the number that I would direct you to is the net contributions. They're positive across the board. Certainly, I take every opportunity to thank for the supplemental funding that was in the budget on the K plan. So that has a large impact as well on the K plan. And then positive on the state police side for the net contributions, the cash flow numbers that we're reporting today. And flipping over to the next sheet on the C side, essentially positive cash flow. We strong interest earnings, so certainly that formula, contributions plus investment earnings, exceeded the outflows for the calendar year, or for the year, fiscal year that we're reporting here today. On the insurance side, we've talked here on previous presentations talking about the volatility on the insurance side. It's really a derivative of the rate. It's going to be a lot more volatile than the pension side. There is some negative cash flow there, but what's interesting to me is that primarily that is really just the increase in the utilization. And Aaron can give a little more details on that.
Yes. So actually, I'm going to steal a little bit of Mr. Craycraft's presentation, but fortunately, and I'm happy to report that the health insurance funds, the 5 funds that we have, are well funded. All but one are over 100% funded, have a 100% funded ratio. KURS non-has is at 81%. So it's not unusual when you have well-funded plans to see a little bit of negative cash flow. And just like Mr. Craycraft said, if it's usually in a small percentage range, that's pretty normal. The actuaries don't get too worried about that. Just like Mr. Barrow said, we have seen premium increases, which of course drive up the cost. We have 2 funds that have no contribution effort. They're at 0% because of how well funded. That's KURS hazardous. They're 171% funded, and CURS non-hazardous, 122% funded. Just like Mr. Craycraft said, he covered the MA plans and the factors that caused some increases in those premium costs last year, applied to our Medicare Advantage plan as well. We do anticipate seeing increases again this year due to specifically utilization across the board in both the non-Medicare and Medicare populations, but particularly the IRA changes for the pharmacy benefits on the Medicare Advantage plan. So.
And just to round out the C insurance again, some negative amortization on the cash flow side, but really that utilization is a big portion of that. And as we do agree with Bo that some negative cash flow is permissible and typically is experienced by most plans over a longer period of time. And wrapping up the last slide that we have for consideration today, looking at fiscal years 21 to 25 are actuals, and then those assumed rates go out through 2028. Obviously, on the K side, you have the biennial budget, so those would stay the same from year to year, but we do see a slight decrease. The C side, a similar type of story, a slight decrease on a forward projection basis. Obviously, we have experience studies. We have amortization of excess earnings above the assumed rate of return. We look at those assumptions. So there's other factors here, but this is the estimate based on current actuarial studies we're able to produce. So with that ends our remarks.
Representative Cabral has a question.
Thank you. Thank you all for that presentation. And I've got a question that has come up. My colleagues and I have received some communications from constituents asking us to protect the pensions and wanting confirmation whether or not we're invested in Trump media in any capacity. Can you all speak to that?
Sure. So there's been 2 iterations of the recent law that require us to invest in pecuniary factors only, just what is best financial interest of the plan. To my knowledge, there's no direct investments, but if you're in an index, for example, S&P 500, that's 500 companies, and you would invest in that index, it's appropriate, it's diversified, and you would mirror that index. So if there are portions in the Russell 5000, et cetera, that we would have in those ETFs or an index, there could be a small portion of it. The logic would be to invest pecuniary interest in the index for diversification. It would not be focused on any individual company's policies, who the owner is, et cetera.
Thank you for that. And I guess my question is, hearing that explanation, I know we passed HB 236 in 2023. It still, at least for my constituents, it feels that we're out of compliance with that law. Are there options that we can take? Because after I received the emails, I was doing some research, and it looks like we're invested in the Russell 3000 and Russell 1000. Is there something we can do to make sure that we are, in fact, in compliance with the law?
So our boards have, a fiduciary duty. So we would believe that we would be compliant with the existing law. We would have to experiment. I mean, again, investing in an index diversifies over across 1,000 companies or 500 companies. Picking 1 or 2 not to invest in, to me, would be outside of pecuniary best interest, because it would cost a lot more to, say, invest in 472 companies of the S&P 500. So we would have maybe some concerns with picking companies not to invest in with existing investment philosophy that, again, is a pure index diversity across a large pool of companies.
Thank you for that. And if we could later, could we have a conversation just so I can allay the fears and concerns of my constituents?
Yes,
That'd be
certainly.
great.
Always happy to help.
That's perfect. Thank you.
Thank you.
Representative Tipton.
Thank you, Mr. Chair. And Ryan, Aaron, appreciate this report. I've been on this board long enough. I've seen negative signs in front of the return, so this is very positive. A couple of questions, if it's all right, Mr. Chair. First, of course, we just heard the report from the judicial system. Obviously, they're a much different system, much different asset allocation, more geared toward equity. They've got the Baird. I know that looking at the percentage of equity in the different systems non-has is probably the least percentage. Are those things kind of tied to potential risks based on the system's performance and unfunded liability? You have less percentage and maybe that that system versus some of the others?
Certainly, the asset class has a great bearing on risk tolerance, and a highly funded plan would have a completely different risk profile, and even amongst our plans, there's different risk profiles, and that's where the asset allocation work comes in with the board and our outside consultants and our internal investment staff, really looking at those across asset classes. So yes, 100%. Focus on risk. And as I talked about that Sharpe ratio, that's even something that we traditionally report. It's in our investment materials that really look at that risk. So the risk adjusted return, our returns are very strong when you factor that in. And that calculation is a little above my pay grade to explain the exact math, but it does look at those risk and the variations over time related to the earnings.
If I could follow up, Mr. Chair, just to the average person looking, they're going to ask the question, why don't you invest this way in all the systems? Have you all ever looked at maybe taking a small percentage of the asset allocation and doing something like they do with the Barrett approach?
Well, so we do. We have large positions in private equity. So, not to compare the plans, but, a well-funded smaller plan would have a way different investment philosophy and asset allocations. So we do have large positions in both fixed income and the public equity, similar to the presentation we just saw. But we would also have some other things, diversification, and look at performance over time related. A lot of times this asset class will perform, and this. So with diversification, and we have some additional real return and real estate in the profile. That helps with that diversification and to mitigate risk across the whole profile.
Mr. Chair, one final question,
Yes,
please.
sir.
Looking at the returns from the different categories, of course, you've got China equities on here, world equities, Japan equities. How much are you all looking at what's going on globally right now with things like tariffs, with things like tensions in the world? I know there's concerns maybe China may make a move on Taiwan someday. When you all look at investment strategies, I know these are great returns. China's economic driver in the world, but how much calculation is taken into concerns about future political ramifications from what's going on around the world?
So that's certainly factored in the analysis in terms of what markets are we comfortable, what markets are we not comfortable with. So that's certainly factored in. However, we are a long-term investor. So any of those short-term tariffs and, that seem to change constantly, so it's factored in the analysis, but we wouldn't necessarily want to react out of a position or into a position based on that short-term. Our fiduciary duty is long-term investment to maximize the return over the longest period of time. So traditionally making good, sound investments and then staying with those and not reacting to the short term typically lends to that philosophy the best. But it is factored in. It's discussed in our investment meetings with our trustees that are on the investment committee. Certainly internal investment staff look at that, among others. Thank you. Sure.
Senator Fromeyer.
That was an excellent answer to that question.
Thank you.
My questions were actually very similar when I was looking at the asset allocation versus the IPS targets and ranges. I'm not real familiar because I am new to the board. So the KRS pension composite versus the SERS pension composite, the actual versus the target, how are those selected? I do see that they're a bit different between the two systems, and I'm trying to imagine the age and risk profile and a number of factors, but
certainly. So the C board would pick the asset allocation, and the K board would pick the asset allocation. So that the process works. It's conjunction our investment staff with our outside consultants, which is Wilshire currently. Will go through a study. They will essentially propose, and we just did this in One was in January 24 and one was in December 24. Both are very recent analysis that's done. You factor in the assumed rate of return that comes from our outside actuaries, and then they'll run various simulations on various market scenarios. So what happens if, and then that risk tolerance is developed by the asset allocation. As I said, that is the biggest driver on performance and risk, is the asset allocation. Mm-hmm. So the ranges will be developed, and then a point estimate, a target, and obviously with valuations, the market's constantly moving. So our private equity piece isn't moving essentially every day, but the public equity piece is. So we wouldn't want to just necessarily react and say, hey, we're too off our target. It would be an overall kind of investment philosophy, just as Representative Tipton said, looking at what's happening in the market today. So it's a multi-step process really and you can just say a plan that's less funded, right, should probably be in less volatile assets. And then if you're fully funded, you could potentially take on more risk, take on more equity, less fixed income, et cetera.
Excellent. And I don't know the makeup of those board members, and that could certainly factor into the comfort for taking on more risk as well.
I 100% agree. Yes.
Yeah. Thank you.
I do want to thank you all, Aaron. Thank you, Ryan. Back to the KERS non-HAS slide that you had, end of period assets, $5.143 billion.
What slide are we talking about?
That's cash flow, I'm sorry.
Cash flow. Okay. Thank you. Yep.
And that back in 2013-14, that was about a little over $1 billion. We were one market correction away from pay-as-you-go.
Yes, 12.8% funded, I believe. Yes.
Okay, so some good work that we have them under the gun for right now.
Yep. Experience on earnings has certainly been positive over that period, as well as the supplemental funding. I'm very appreciative of that. It makes a huge impact on the cash flow.
Could you, I know you explained the negative cash flow, but still that's a significant increase from the previous year in the CERS non-HAS. Did that have anything to do with the rate reduction or contribution rates?
Do you have that one?
I'm sorry, can you ask that question again, Senator Higdon?
Net, you had a negative cash flow.
Yes. So on the insurance side, we do have a small.
Is that the insurance side?
Yes. Yep. There is small negative cash flow, and I'll just start and let Aaron finish. You know, what we see is some of that is related to, you can just look at the increase in the outflow from fiscal year 24 to 25. And, you know, a large portion or all of that cash flow, negative cash flow, is really a derivative of that increase in usage.
Mm-hmm. Mm-hmm. I agree.
Yeah, CERS non-HAS, but it was a considerable increase from last year.
You're talking about the pension fund, sir?
Yes, I'm sorry.
Go.
We have too many charts.
Yes, there we are. CERS non-HAS. The increase in the contributions, or I'm sorry, can you state your question again?
So net contributions are positive. When we back out the investment income, it would be negative. But the combination of inflows plus earnings, less outflows, is net contributions. That's what we call cash flow. It does have some accruals in there, but that is essentially our cash flow number.
Okay. One other question about the any indication or increase in the KPPA's Medicare Advantage that we're seeing in the other plan, the judicial retirement plan?
Mm-hmm. Yes, Our retiree health plan committee meets on Tuesday, September the 2nd. There will be more information provided as far as premium amounts for 2020, and decisions will be made there. So,
Okay.
but we do expect an increase from this year.
As drastic as the legislative judicial plan, I think Bo said, what, 38%, something like that. It was very high.
From it is, I will say it is. Yes, it would be higher than we liked. There will be significant discussion about the causes for that, and again, it's particularly the utilization in the Part D changes on the pharmacy benefits that were attributable to the Inflation Reduction Act that's causing that drive.
Well, thank you very much. Okay. Chairman Petrie has a question.
Thank you, Mr. Chair. You've made reference to the over and above contributions, I think 250 million and 250 million to the K plan, and how that does have an effect. Is there a way for you to back out those over and above contributions and be able to determine what your cash flow would have been and your assets, just as if those two payments were not being, or those payments were not being made? I'd almost like to see that for 2 to 4 years, because we made substantial over and above payments. I'd like to see how the health of the systems without those over and above. How difficult would that be to do?
I think we can do that. There's an accounting way to do it, and then there's an actuarial, because some of that is not recognized immediately. Some is paid monthly. So essentially, the excess funded goes to the bottom line. It's a question of the timing, so we will work on that in a chart to back it out.
If you can get that back to the committee, I'm interested in it. If the chairs want that. I think it gives me a better estimate of the health of and the situation of the plans, because those are one-time hits.
Yes, sir.
Yeah, thank you.
Thank you, Mr. Chairman. Yes, we're definitely interested in that, so thank you very much. Seeing no further questions, thank you all for being here. Appreciate the report.
Thank you.
Okay, next up, Bo Barnes, TRS. Bo, welcome, and you know the procedure, and introduce yourself for the record, and the floor is yours.
Good afternoon, Mr. Chair and everyone. My name is Bo Barnes. I serve as Deputy Executive Secretary and as General Counsel for the Teachers Retirement System. I've been asked to present or speak to the same agenda items. I hope that looks okay. That you've heard already, presented before, just before. I will note, and I've been asked to speak to this as well. You heard that Judicial Form Retirement Systems just had a 5-year experience study conducted. TRS also, its independent actuary, also conducts 5-year experience studies. The last 5-year experience study was the 5-year period ending June 30th, 2020. Many of you all will recall that there were significant changes made to 2 actuarial assumptions. One, they lowered significantly the assumed rate of return to 7.1%. Also, very significantly, the Society of Actuaries for years have been working on a mortality table that was more specific to teachers. Of course, teachers live longer than the average population, so higher mortality, higher liabilities with that. They also adopted, as part of that experience study, an intergenerational mortality table where someone who is age 25 is expected to live longer than someone who is age 55. And to get to Senator Funky Frohmeier's point, that was for the period ending June 30th, 2020. They will be aware of recent trends, showing maybe some declines in mortality. I know there'll be something they'll be looking at when they're conducting this experience study. These assumptions are long-term. I will caution that. They're not 1 or 2 or 3 or 4 years, but, they look at a little bit longer. So we at TRS staff are always interested in seeing how the experience study comes out. So that will be available. First, they have to do the annual evaluation for 2025 because that's one of the 5 years that's used in this current 5-year experience study that will be for the June 30th through June 30th, 2025. That annual evaluation will be ready no later than November 15th. And then after that annual evaluation is complete, then they can use it with the prior 4 years to work on that 5-year experience study, which will be ready sometime next year for presentation, to this board if it so desires. So that covers that. Now I'll get into the presentation, and again, same topics that you've heard before. First, we're going to cover investment returns, and this is for the retirement annuity trust. Some people call it pension, and these are unaudited and preliminary returns. They're for the period ending June 30th, 2025. And I'm really just going to focus on the bottom 2 rows of this slide. You'll see at the very bottom, left-hand corner, the word net. That's net returns after all fees are paid to invest teachers' money. And just above that, you see Aon rank. Aon provides a peer ranking with other large public pension plans with $1 billion in assets or greater. So starting again on the far left of the far left column, you'll see that for the quarter, for those 3 months ending June 30th, 2025, the returns were 7.77%, which placed TRS in the top 1% in the country compared to its peer group. For the one year, the returns were 12.04%, placing TRS in the top 6%. For the 3-year period, the returns were 11.41%, again placing TRS in the top 6% compared to the peer group. For the 5-year period, 9.81%, placing TRS in the top 23%. You can see those are 3 years in a row of double-digit or very nearly almost double-digit returns. For the 10-year period, we had returns of 8.36%, placing TRS in the top 6% in the nation compared to its peer group. 20 years, 7.65% returns. We don't have peer group data available for that time period. And then at the very bottom, you'll see the 30-year compounded average, 7.95%. And TRS, as I always, remind everyone, we are a long-term investor, so we're not always going to do great year to year compared to our, peers. We're going to have off years. We're going to be invested in some good, sound, fundamental investments, but those aren't always in favor of the market. Sometimes they're in, sometimes they're out. But we take a long-term approach so that over the long term, we can perform as a top-tier investor. I will also note that every single one of those time periods exceeds TRS's assumed rate of return of 7.1%. This next slide, we have the same format pretty much, except for this is for the health insurance trust. So we report these separately, and I'm just going to focus on the bottom row for this slide. You'll see net returns for the quarter, 7.57%, 1 year, 12.3%, 3 year, 12.09%, 5 year, 10.78%, 10-year, 8.21%. We don't really go up beyond that because before the 2010, what we call the share responsibility legislation, where active teachers, school districts, and retired teachers all contributed significantly more money into the health insurance trust. We didn't have a funded health insurance trust. We had a bank account, a checking account, where dollars would go in and dollars would go out to pay health insurance bills as they were due. But with share responsibility in 2010, with that momentous legislation, we've moved from a fund that was 3.5% funded to one that was just over 80% funded last June 30th. So we now actually have a fund with a fund that's actually has money in it that we're investing and having returns. The next slide, we're going to get into our cash flow slides here. The first one is for the Retirement Annuity Trust. And it's for the period as of June 30th, 2025, that ending period. And as I always point out with these cash flow slides, you can divide these into thirds. The top third of this slide is going to show cash inflows to the Retirement Annuity Trust. The middle third will show cash outflows from the Retirement Annuity Trust. And then the bottom third kind of shows the results of those cash inflows and cash outflows. And going to the right of this slide, you'll see two columns from the right, FY 2025. So those are the most recent numbers, for the fiscal year ending June 30th. And then to the right of that, for comparison purposes, you'll see the same numbers for fiscal year 2024, ending June 30th, 2024. So let's start at the top. You'll see cash inflows in the form of member contributions for 2025 were $401.3 million, compared with a year ago, $385.9 million. We have employer contributions, $1.363 billion for 25 versus $1.178 billion for 24. The next line that we have here is investment income, and that specifically here, the investment income are stock dividends and investment interest on fixed income investments. And then you'll see that the total cash inflows for 25 were $2.148 billion versus $1.997 billion for 2024. Going to the middle third of this slide, we're going to see the cash outflows. And of course, as you'd expect, the largest outflow is the benefits that are paid out from the Retirement Annuity Trust. And you see in 2025, retirement annuities were paid out in the amount of $2.554 billion compared to $2.499 billion the year before. The other expense here we have is administrative expense, $15,100,000 in 25 versus $14,800,000 in 24. And you see total outflows, $2.570 billion for 25 versus $2.514 billion in 24. And then we look at the cash flow, which compares the cash inflows versus outflows, and what do we have? And we see there for 2025, we have negative cash flow of $420,900,000 compared with $517,500,000 in 2024. So a slight, not a decrease, not slight, but you have a decrease in negative cash flow between those 2 years. And as you heard earlier, with more mature public pension plans, having negative cash flow, some negative cash flow is not a bad thing. You can have too much negative cash flow. And before TRS started receiving the additional funding it requested and then began receiving that in 2017, our actuary was concerned that our negative cash flow numbers were getting too large. Our actuary now is very comfortable with where our negative cash flow numbers are. And as I always like to say, the top two-thirds only tell part of the story. You really have to go to that next line to see the health of the Retirement Annuity Trust. And that next line, investment gains or losses, that represents both increases in the value of the investment portfolio that we still hold, and also it reflects where we've harvested gains, where we've sold assets that we saw were kind of highly valued and maybe they were ready to sell. So you see with that we had investment gains, realized and unrealized of $2.62 billion for 2025, up from $2.381 billion in 2024. So what does all that mean? Looking at the column second to the right, bottom two numbers, that top number, that represents the assets in the Retirement Annuity Trust as of July 1st, 2024, and you'd see we have $26,108,100,000 in the Retirement Annuity Trust. By June 30th of this year, over that 1 year period, they had grown to $28,310,300,000, or a gain of just over $2 billion over the 12-month period. Next, this is the cash flow update for the Health Insurance Trust. Same format, same time period. So I'll go over that. Starting at the top, you can see for fiscal year 25, member contributions $160,400,000, compared to 2024 $155,300,000. Employer contributions $237,200,000 compared to a year ago $224,300. Recovery income, and recovery income represents prescription drug formulary rebates, and also federal subsidies that TRS is able to achieve. And these are very significant. These are a major source of funding for the Health Insurance Trust. And these sources of funding have been fairly consistent since we started share responsibility in 2010. But as we note, if any of these federal subsidies or formulary rebates were to change, were to be reduced, that would impact the funding for the Health Insurance Trust. But knock on wood, they've remained relatively constant, and hopefully will continue at the current levels. Also, we have investment income, again, stock dividends and interest on fixed income, $53,200,000 for 2025, $52,100,000 for 2024. So total cash inflows of $631,400,000 in 25, compared to up from 2024 where it was $588,500,000. Cash outflows. We paid out in health insurance expenses $344,100,000 in 25, compared to $300,300,000 in 24. Administrative expense, $2.1 million in 25, same from last year, $2.1 million. Total cash outflows, $346,200,000 in 25, compared to $302,400,000 in 24. So cash
Bo,
flow.
Can I interrupt you?
Yes, sir.
Senator Fromeyer has a question.
Yes, sir.
Thank you. As I'm puzzling through the numbers, I'm trying to understand, and I'm still a little bit stuck on the last slide, the retirement.
Sure. You want me to go
annuity.
back?
Yes. When I look at the difference of fiscal year 24 to fiscal year 25, and I see that the employer contributions are dramatically higher in 25, and I'm trying to think through our legislation, yet the member contributions are not dramatically higher, or proportionally higher, I should say. How did we put 1.178 billion in 24 and then 1.363 billion in 25?
That could be a function of a few things. The member contributions are set at a fixed rate of 3.75% of their paycheck goes in. I'm sorry. Maybe I'm still on the health insurance trust slide. This is the retirement annuity trust. So member contributions are set at a fixed rate, okay? And those fixed numbers increase as payroll increases because it's a percentage of payroll. And it's about 13% for our members who are in TRS, our account types TRS 1, 2, and 3, 11%. Well, actually, it's 14.75% for our members who are in TRS 4, okay? So 12.855 for 1, 2, and 3, and then a little more for TRS 4. But those are fixed rates. They will go up as payroll increases. The employer contributions, those, and I'm sorry, again, I keep on including health insurance, but I'm just focusing on retirement annuity trust. It's going to be 9.855% for 1, 2, and 3 for the retirement annuity trust, and 11% for TRS 4 for the retirement annuity trust. But employer contributions, there is a fixed statutory rate for employer contributions. That fixed statutory rate provides for what we would call normal cost, how much we need to set aside each year of a teacher's career so that when they retire, on actuarial average, we can pay that retired teacher's retirement benefits, retirement annuity for the rest of their life. That's normal cost. but, you know, we're 59.1% funded as of June 30th, 2024. So we want to be fully funded. So like any retirement system that's not fully funded, we're requesting an additional payment over and above what is called normal cost. And we're getting some of that additional payment in the fixed rate, just not enough. So we need more, but we're asking for additional money so we can implement our funding plan to pay off this legacy unfunded liability. It's going to be paid off on an amortized basis, like paying off a home loan. It's akin to that. So we are getting additional money from the Commonwealth that's not pegged at a fixed rate. It is based on this amortization schedule that we have in place to pay off this legacy unfunded liability. And that's why you're seeing increases in the employer contributions that are going to be dissimilar from increases in the member contributions. I hope that explains that. I know I went into a lot there, but
That's helpful when I'm thinking about how difficult it must be on the actuarial calculation as well, where we've puzzled around unused sick pay that could be different across school districts, or unused vacation, or different things that might not have been actuarially estimated.
Yeah.
So then you're trying to estimate sort of an unknown.
or
Is it more known now in your process of estimating?
Well, a couple of things, and we do have some trend slides coming up, which will show how employer contributions are going to increase. You know, they're going to sort of level off in some out years, okay? We're talking about maybe around 2040 or so, okay? But in the early years, you're going to see an increase in employer contributions. But our actuaries are using, I mean, they look at these actuarial assumptions: mortality, investment rate of return, rates of retirement, payroll growth, individual salary increase. They look at all these different assumptions. And, you know, we get a pretty good idea of where these things are going. Plus, every year they look at those assumptions, every single year. And if investment returns are not as high as they expected, that's a loss for that year. Or if mortality is higher than expected, that's a loss. But they look at several different items, actuarial assumptions, and do we have a gain or a loss for that year? Some years we have gains, some year we have losses. They somewhat offset each other. But every year that's in the actuary's annual evaluation. You'll see it in there. And then those changes, you know, you have this what was a 30-year path. Now we've shortened it. We're going to have this unfunded liability paid off in the mid-2040s. Every year, instead of just following that path and making changes to actuarial assumptions every 5 years experience study, they're capturing that every single year. And they are making that part of our budget request, whether it's a gain or a loss. That gain or loss is amortized over a 20-year period. And again, you've gained some year, losses another. So it's not a big shift, but as we follow that longer 30-year, now less, path towards fully funding, every year along that path, we're making little steps to the left with a gain, little steps to the right with a loss. So they're keeping track of this constantly. So it's not like we're shooting from here to there with no adjustment. There's adjustments every year. So we feel good about this. Our actuary is certainly, they work with a lot of retirement systems across the country. They've seen retirement systems that are further along in the amortization schedule than TRS. They've seen the same thing happen for those retirement systems that they have seen so far with TRS and project will happen with TRS, and that with this continued full funding that we're getting, and you know, TRS and you know, all members, teachers, everyone out there are extremely thankful. I can tell you, I talk to teacher groups. They are so thankful for this additional funding that's been coming in since 2017, and what a game changer that's meant. That we know that we've continue with that additional funding. You know, we will continue along that path, and this the system will be fully funded. The Retirement Annuity Trust will be fully funded at the end of the amortization period.
We'll get the house paid off.
Yes.
I like it.
Yes.
Okay.
Thank you.
Representative Tipton.
Thank you, Mr. Chair. I was going to wait a little later, but I think it's a good time to ask my question as a follow-up to Senator Funky Fromeyer's question. And I may give a little history lesson, then ask a question, if that's all right.
Please
Mr.
proceed.
Chair. And it goes back to especially some of the members who haven't been on this board for as long. There was a period of time from 2008 to 2016 where the state did not make any contributions to the unfunded liability portion. Remember the '08 economic crisis, there were big cuts there. Into 2000, and of course we always made the statutory contribution, that percentage, always made that. In the 2016 budget, the General Assembly appropriated $973 million over the biennium to fund that unfunded liability portion. That was 93% of the request, if I believe. Every year since then, every budget since then, we have funded 100% of not only the statutory but that unfunded liability. And also, I believe it was 2022, Chair Petrie put an extra $479.2 million in.
That's correct.
To pay off some amortized costs dealing with sick leave and some additional COLAs that were amortized. So we've had all this money go in. And Senator Funky Fromeyer, when you see the out-year charts, you're going to be shocked at what the costs are going to, particularly on the unfunded liability. The total, I think we're going to eventually get up. The total cost for TRS is going to hit $2.6 billion in 1 year, based on the old chart that I saw. And the year that unfunded liability is paid off, it drops to $878 million from 1 year to the next. Yep. So that's going to be the impact of that unfunded liability for years to come. So my question for Bo is, we're making the payments. We've put extra money in. What is driving up, help me explain to my taxpayers so they understand, my citizens, what is driving up the cost of this unfunded liability? Is it the assumption changes that were made previously? Is it just a factor that benefits are increasing based on we've got teachers that are having higher salaries now, and as they get closer to retirement age, they're going to have higher retirement benefits? Could you kind of give us some context? What's driving up this cost?
Okay, a couple of things there. With the actuarial assumption changes as a result of the last experience study, for the period ending June 30th, 2020, made some major adjustments that added liabilities, to the system. Going from 7.5% assumed rate of return for the retirement annuity trust to 7.1%, that's going to drive up liabilities because most of these benefits, most of these retirement annuities, the lion's share, is paid for with investment income. Same thing with a 401k account. It's not what you put in there, it's what you earn over your career on those contributions you put in your account. So that was a big change, and the mortality table was a big change too. Those were, kind of watershed moments. You don't always see big changes like that as a result of an experience study. Significantly, with the reduction in the assumed rate of return from 7.5 to 7.1 to the retirement annuity trust, that liability was recognized immediately on our books and our financial statements, for everyone to see. The actuary recommended what actuaries will do, that if you have a big change, that you can smooth in to the cost in the budget for that actual change. So they recommended that, not for the mortality table change, but from going from 7, that was built into the budget immediately. But going from 7.5% to 7.1%, they said, smooth that. We can smooth that in over 5 years. They recommend smoothing in over 5 years. So instead of paying that all at once, you have one big increase. You're going to see an increase over 5 years that's reflected by that. Also, the way that we pay off this legacy unfunded liability is that we assume that payroll is going to grow, You're going to see inflation in total payroll. That's a function of either higher salaries that teachers earn or increase in the number of teachers. Both of those will increase payroll. And as that goes up, you assume you're going to start paying more towards this retirement annuity trust. Some retirement plans use another system where it's like more of a level dollar amount. They don't follow inflation with payroll growth. TRS does. So those are the two biggest reasons that you might see or rather sooner, an increase, here in the next few years as those 5 years are brought in, but also longer term. Now, also, I always like to point out, that with this, and those years that Representative Tipton pointed out 2008 to 2016 were big. And granted, as Representative Tipton also pointed out, that was the 2008 financial crisis, Great Recession. Revenue, I know, got really tough for states and public entities. It was hard to make budgets work sometimes. There were a lot of competing demands right when revenue was dropping. So I realized that was a bad period, but we never really got back on track after we had sort of a rebound from that period. And so we got behind, okay? Not only is it that TRS didn't get those full contributions that were being requested and needed. It's not just that, it's the investment income that would have been earned on those contributions every single year. And there have been a lot of good return years, over that period of time. So that combination of things, really, you're going to see some increases. Also, that gets to another issue. And I'll save that for later, but hopefully that provides some explanation about why we're seeing these increases.
Okay. Please proceed.
Okay. That finished the cash flow sides for retirement annuity trusts and health insurance trusts. Now we're going to get in some trend information. And this first trend slide we're going to start with is not the retirement annuity trust, but the health insurance trust. And we date this back, this goes back from 2009 to 2025. And you'll see some columns in the boxes on the left and right. And then the first column in each box is just the fiscal year, 2009. That's before, that just epic piece of legislation, shared responsibility, was enacted. That's when health insurance for teachers was pay as you go. So that's why we started there. Then you'll see what the state is contributing to health insurance, what employers, are contributing to health insurance. So by employers, local school districts, universities and other employers, for every position. Then you'll see what members and retirees are contributing towards the cost of health insurance. And I'll just point real quickly, for maybe our newer members, before shared responsibility, before 2010, the Commonwealth was paying voluntarily almost the full cost for retired teachers' health insurance. And I say voluntarily because although most benefits that teachers have are guaranteed by a statutory and viable contract, the only thing that they are guaranteed in regard to health insurance is access to group coverage. But the levels of coverage and how much they have to pay for their health insurance coverage is subject to change depending on the funding available. But with shared responsibility, the Commonwealth shifted from paying almost the full amount voluntarily to having other employers like school districts stepping in, phasing in over a period of years of paying an additional 3% into the health insurance trust. Active members paying an additional 3% out of their paycheck into the health insurance trust. And retirees under the age of 65 paying an amount equal to the Medicare Part B premium equivalent towards the cost of their health insurance. So these numbers are pretty simple. You can see how the state was paying more, and you can see how other employers and members and retirees sort of slowly started phasing into paying their full amount under shared responsibility until we get to 2016, and they're paying the full amount. And then you can kind of see where we are in 2025. Again, this slide is pretty self-explanatory, I think, but if there's any questions, I'd be glad to take those. Next slide shows the same trends, different time period for the retirement annuity trust. With this, we start at 2019 and run it projections to 2028. And on this slide, looking at the columns next to fiscal year, you see the state unfunded liability payment. And that is really the issue, that we have is there's a legacy unfunded liability. If this legacy unfunded liability did not exist, if TRS retirement annuity trusts were fully funded, that $669 million would disappear. It wouldn't exist. But until we get that legacy unfunded liability paid off, there's going to be a number in that column. And then you see the state fixed amount. That's a statutory fixed amount that I talked about earlier. Then you see that next to it, employers fixed. Again, that's those other employers we have. In the local school districts, that's going to be federally funded positions. Traditionally, about 10% of teaching positions in the districts have been federally funded positions, and federal funds pay for the retirement contributions.
Let me, under employers fixed, why theirs reduced and looks like everybody else is increased on that. Employer went from 102 and 23 to then dropped down to 80 in 26, 27, 28.
Those represent some shortfalls in funding, represented by, from what I understand, are some reductions in federal funding for some of those positions that I just talked about. But those are shortfalls in funding. Something else with these numbers going into the future, these are projections. So if you see fixed, you have a fixed percentage applied to, payroll, and so if payroll is different than anticipated, we can have an over and under that we make adjustments for in the next budget biennium. But that's my understanding. We had an underage for those 2 years. Not necessarily that those costs were reduced, but we had an underage. And it's my understanding those came from federally funded positions. There could be more to it, and if there is, I'll follow up. And then
Chairman Petrie has a question.
Thank you, Mr. Chair. On the slide that's in front of us, retirement annuity trust contribution detail, I want to
Yes.
make sure state fixed that's the percentage of payroll
Yes.
factor.
Yes.
Is there any other factor in that aside from payroll? That's the sole factor, correct?
Yes, it's that percentage amount that the state's going to contribute based on which account type it is, TRS 1 through 4, applied to payroll.
Okay. So really, if we have on state fixed, we know the number of people involved and a dollar figure, then we can see how the trends flow as far as payroll going up.
Yes.
As opposed to number of employees increasing. We can find that out pretty easily.
Yeah, you see how payroll goes up, and again, that can be a function of increases in salary or increase in number of employees. Both of those will.
We have numbers of employees pretty
We do.
easily.
Yeah.
All
we
right,
do.
very good. Thank you.
And then I think that just left the last column, and that's the members' fixed contribution rate under statute that they contribute towards retirement annuity trust. This next slide, and this has been presented to this board before, and it just shows graphically what we're looking at long-term with the funded ratio, unfunded liabilities, and contributions that will be requested of the Commonwealth. And looking at that top box, you see that dark blue line. That's the funded ratio. And you can see we're still kind of, in the early part of that amortization period. And you see it's kind of flat, that the funded level is kind of flat. And there were little growth, just a little growth over those years. That trend has been projected by the actuary for years in their 30-year projections, and before that it was 20-year projections. That's what you see not just with TRS, but that's what you're going to see with any retirement system that's in the 50s funded level that is now starting to get money coming in. Again, going back to the home mortgage example, it's akin to a home mortgage. The early years of paying off that mortgage, you're going to be paying a lot more interest than principal. Everybody who's had a home mortgage has seen that. And then as you get further into the amortization schedule, paying off that home mortgage, you start paying more and more principal and less interest. And finally, it flips. You're paying more principal than interest. The same thing essentially happens, with a pension fund. And that's what you see, that in a few years we're going to start seeing, as projected by the actuary for years now, not now, but in just a few years, a few short years, you're going to start seeing that funding level start going up more significantly every year and increasing every year. and flattens out until when we get fully funded. The two lighter lines above that and below it, the dark blue line is predicated upon a 7.1% investment return. The light blue line above it is like, what if we had 8 and 1%? What would it look like? The light blue line below it, what if we had 6.1% return instead? What would that look like? And then the gold line below that, of course, just shows the unfunded liabilities. And you see that when we get through the amortization period, those drop to zero. The bottom box, that required contributions that are needed for the retirement annuity trust. And you see that dark green line shows that there's an increase. We're going to see an increase. Starts kind of, flattening out a little bit there as we get into 2040s. Even a little decline there, slight decline. And then when we get to fully funded, those contributions, plummet that we will need from the state, okay? Because at that point, we only have the normal cost left. At that point, we no longer need that additional appropriation that we've been talking about that we didn't get from 2008 to 2006, or we have been getting from 2017. No longer need that. And in fact, the fixed statutory rate that we are currently receiving, right now with the way these benefits are, that's more than what we would need from the normal cost. Some of that is paying for the unfunded liability as well. So there is, at the end of the amortization period, there is relief. Here's a trend, and this is just sort of a different way of showing what we saw on the previous two slides, or actually, the previous two slides, kind of just putting them all on one slide. For the period from 2019 to 2028, you'll see first for the retirement annuity trust, the state contributions in dollars. Then you'll see next to it what our non-state sources of funding are, our other employers, like the universities, federally funded positions in the school districts again, what's coming in from that. In the middle two columns, you're going to see same thing for the health insurance trust. And then in the kind of last three columns is just total, all of that. So you can see the total contributions. Budget request. So you can see some past history here. I'm going to focus on what will be presented to the General Assembly at the upcoming session when it considers the budget for the next biennium. So we'll start with 2027 pension, $1.125 billion. The state shared of share responsibility, their contribution towards health insurance. And I'll just note real quickly, there's a 0.75% that comes in from the state. There's also the state under shared responsibility, instead of voluntarily paying for almost all of retired teachers' health insurance, they're paying for health insurance for our retired teachers under age 65 in the Kentucky Employees Health Plan, less what that retired teacher pays. So this is just a rough numbers, but so for like a $700 premium, the state's paying about $500 for that retired teachers under age 65, and the retired teacher's paying about $200 of the cost of their health insurance. Those two numbers do not include the SEEK formula. So the state makes on behalf payments on that fixed statutory rate on behalf of the school districts. It goes to the SEEK formula. That's an additional $530 million in 2027 for a total of $1.7 billion for 2027. Fiscal year 28, we see at the top, there will be a budget request the TRS will make. The SEEK formula request, that actually comes from the Department of Education to the Commonwealth. On behalf of the districts. But going back to that 2028, the $1.152 billion number, that's a budget request by TRS for the pension. The state share responsibility portion for health insurance is $103.1 million. Funding from the SEEK formula is projected to be $541 million for a total of $1.8 billion. I also have here a couple of slides, because we've gotten some questions about this recently. And I thought this would be helpful. These are updated numbers too that we've been following this. Spoke earlier about there being 4 account types at TRS. TRS-1, TRS-2, TRS-3, TRS-4. Just very quickly, I think it's helpful for this body to understand these fully. TRS-1 is established for individuals who become members of the system before July 1st, 2002. TRS-2 is for people who became members on July 1st or after and by June 30th, 2008. Okay, that's TRS-2 for those set years. TRS-3 is for individuals who became member of TRS between July 1st, 2008 and December 31st, 2021. And TRS-4, our latest account type, which is fairly new but growing very significantly, and that next slide will show that, is for individuals who become members of TRS on or after January 1st, 2022. And there are a lot of differences in these 4 account types, many. I'm going to point out just a couple because we've got a lot of questions about this. For TRS-3, sick leave that can be applied, unused sick leave that teachers can be paid for at retirement by school districts at 30% of their daily rate, and having that lump sum payment added to their final average salary, to their last compensation for inclusion in their final average salary retirement calculation purposes. That's capped for anybody in TRS-3 at 300 days, no more than 300 days. And I know that sounds like a lot, and it is. Most of our members do not have more than 300 days, but we do have members that have more than 300 days. Mostly and typically, because we look at these accounts, we're kind of curious about who are these people. Almost in all cases, not all cases, but almost all cases, it is someone who's had 2 things happen. They've taught a really long time, and they've been lucky enough to be healthy and not have to use their sick leave. That's what we see. The other
Bo,
thing.
excuse me.
Yes, sir.
You're leaving out some. I see the sick leave stuff quite often, and how many days people turn in. And you said mainly because somebody worked a long time.
There are exceptions.
There's a lot of exceptions. So you really need to be upfront with us on that. A lot of administrators accumulate a lot more days than teachers do. And you also know that this year I had a lot of conversations with you about annual leave and the fact that administrators were rolling the annual leave is capped at 60 days. And we talked about this. They were rolling annual leave over into sick days. Now, there's a lot more to that story. And it's not because a lot of teachers are working a long time. In fact, that's probably less likely than the scenario I'm giving you now. So I want you to be upfront about that because that happened for years, and TRS let that happen. And like I said, Senate Bill 9 put an end to it, but that was never the intent of annual leave is for it to be rolled over in sick leave. Was not the intent.
And that point is well taken, Mr. Chair. I will say, TRS has an administrative role with sick leave. It's pretty much perfunctory. That there are some limitations, or state limitations that we apply, but largely our role is we have sick leave reported to TRS, and then we are to apply that as the statute requires, for retirement calculation purposes. We have had some differences over the years. Certainly there have been some outliers over the years. My recollection is we had one employer that was providing 20 sick leave days a year at one time. And some days do roll over. Not many of those do now. With our most recent review of sick leave policies, it looks like we have 3 employers that allow annual leave to roll over into sick leave for inclusion in final average salary. There's another way sick leave can be used, and I'm glad to talk about that too. It's not sick leave as salary credit for inclusion in final average salary, but it's to add days of service. And I know there's questions about sick. I'm more than happy to discuss those in detail. But we have seen in more recent policies, sick leave and annual leave, a little more consistency. as a result of Senate Bill 9, we saw a lot of districts amending their policies because now districts have an actuarial obligation to pay the cost of sick leave exceeding 13 days. They also have an actuarial obligation to pay the cost of annual leave days that roll over into sick days. So staff have been taking these new policies in. They've been coming in even into the start of this fiscal year. We're still getting a couple of new policies from districts as they change. And a lot of that is in response to Senate Bill 9. So good point, Mr. Chairman, for sure, certainly.
Representative Johnson has a question.
Thanks, and Bo, I think you probably just answered the question I'm going to ask, but for clarification purposes, I'm going to ask it anyway. For these sick days that get rolled over, that the school system's allowed to be rolled over for calculations for final pay, who is paying that additional cost for those sick days that are rolled in? Is it the system, school systems, or is it the state?
Okay. So, for school districts, they are, unused sick days. And this is the Department of Education statute. It's KRS 16155. It's not even a retirement system statute. But under the Department of Education leave statute, it provides that school districts voluntarily, they don't have to, but they may compensate their retiring teachers for their unused sick leave at 30% of their daily rate. The school district makes that lump sum payment to the teacher, to the retiring teacher. That lump sum payment under that Department of Education statute, TRS is just an administrator. We don't have discretion under that statute to say, no, we're not going to take that. TRS takes that lump sum payment. It's required to add that to the last annual salary of that retiring teacher, which then goes into their final average salary, whether that's depending on how old they are and how many years of service they retire with. It can be their 3 highest salaries or their 5 highest salaries, and that rolls into their final average salary retirement calculation purposes. From, that payment, that 30% payment, we get retirement contributions on that. But the actuarial cost of sick leave, as when we call it salary credit, when that lump sum payment is used to boost their last annual salary and their final average salary, the Commonwealth pays for that actuarial cost.
The state. Yeah. All right. Thank you.
Representative Tipton.
Thank you, Mr. Chair. Since I don't have to go home and milk cows tonight, I'll ask another question. And my question is dealing with the 1.5% cost of living adjustment for retired teachers. That's in statute.
Yes.
I've always heard the number that's paid for by a 1.71% contribution out of the teacher's portion of the required. Is that 1.71% in statute anywhere, and how was that number determined?
Teachers have a statutory cost of living adjustment that's guaranteed under that statutory and viable contract. It's 1.5% a year. TRS is a Social Security replacement plan. Teachers do not participate in Social Security from their employment as a teacher. Social Security provides, cost of living adjustments routinely, often more than 1.5%, and we hear about that, but teachers do have a 1.5%. That is baked into the contribution. Our actuaries account for that's part of that fixed contribution rate that TRS is getting to pay for the normal cost of that 1.5% cost of living adjustment. So it is, you say, a pre-funded benefit. We do have a legacy unfunded liability, which means that all benefits payable by TRS have a share of that legacy unfunded liability. So that legacy unfunded liability is something that's being paid for by the Commonwealth with these additional payments that it's been making since 2017. I can tell you our membership is very thankful for it.
Mr. Chair, if I could follow up. So,
yes, sir.
The 1.71% was an actuary number.
Yes.
That they determined this is what it's going to take to pay that. Now, you mentioned the unfunded liability added on that. What is the true cost of paying the 1.5% COLA when you include the normal cost and the unfunded liability?
Well, so what the state is paying for unfunded liability and everything, that's, I don't have a percentage on what that would be, but, for everything, you saw on the unfunded liability,
So
especially after all those years.
It's very likely that the cost of the COLA is not covered by the statutory responsibility, and the state's backfilling that with the unfunded liability payment. Part of that for the unfunded liability payment. Is that a fair assessment?
Yes, like all benefits, that monthly retirement annuity, it has an unfunded liability that the fixed statutory is not covering, and the state's paying for the additional to pay off that off. Yes, that's correct.
Bo, that our increase in payments every year, like $600 million over the last several years, I guess the steady flow of unfunded liabilities is that's calculated in that. I'm sure. Every year we have sick leave and annual leave that's paid that's in excess of what it's all unfunded liability.
Yes,
and
sir.
so that adds to our. That's part of why these contributions are stair-stepping up.
The annual and sick leave are part. They do compromise. Their benefits, so they do compromise part of that unfunded liability. Now, the state did pay off retired teachers' sick leave liability with that payment that Representative Tipton was talking about earlier that we received a few years ago. But there's still a liability for active teachers. So we actually kind of split out the liabilities for sick leave, and a large part of that was addressed to the liability for retired teachers had accrued for sick leave, but we still have the active teacher liability left.
Okay, please proceed.
So going back to TRS-3, I think the last thing I noted was that sick leave for TRS-3, members and that's anybody who becomes a member of TRS on or after July 1st, 2008. They're limited to 300 days, no more. Okay. The other thing that TRS-3 did, that pension legislation, was that none of our members can use annual leave, towards retirement, okay? For people who are in TRS 1 or 2, our statute provides that, compensation for their unused annual leave up to 60 days, there's a cap, up to 60 days, a lump sum payment for that can be added to their last annual salary for retirement calculation purposes.
Bo, that's paid at 100%, correct?
I'm sorry. Yeah, that's 100%. Yeah, they get paid for 100% of their annual leave, unlike sick leave, which is KDE statutes. It's just 30%. The statute for annual leave, they get full payment for annual leave. That's correct, sir. And TRS-4, and again, there's more differences between TRS-3 and 2 and 1 than those two. But I know it's been a topic of conversation, so I thought I'd point those two out. TRS-4, there are even greater changes, It's a hybrid plan. It's part pension. It's part savings account. Teachers have to be age 57 before they can retire. There's a lot of differences. But also in regard to sick leave, teachers in that tier, and this is for individuals who become members of TRS on or after January 1st, 2022, they cannot have sick leave applied, payments for sick leave made to them and applied for their last annual salary for retirement calculation purposes. They can't. It ends, okay? They can, and not to muddy the waters, but this board obviously needs to know, and it's been discussed here before, all that ends for them. They can no longer use a lump sum payment to increase their retirement from unused sick leave at retirement. There's another statute, and it is a TRS statute. And this TRS statute says that employers may, and this would include school districts don't do this. School districts pay teachers that lump sum at 30% of their daily rate, and that's then put in their last annual salary. But school districts could, and many of our employers do, they can voluntarily pay the actual cost of adding unused sick leave, not as what we call salary credit that is added to their last year's compensation, but as what service credit. So the best way to explain that is an example. So if a teacher retires with 30 years of service, but they have 30 unused sick leave days, that employer, if they choose, may pay TRS the actuarial cost of those 30 days of unused sick leave. So that retiring teacher is not retiring with 30 years of service. They're retiring with 30 years and 30 days of service. That's sick leave as service credit. So for TRS 4, they can't get sick leave as salary credit added to their last year's compensation. School districts could, I haven't seen any that have, could start paying for them to use that as service credit, but the school district has to pay for the actual cost, not the state. And then TRS 4, just like TRS 3, annual leave payments for unused annual leave, that can't be used for retirement at all, okay? Now, this is interesting. We just updated this. So this is a pie chart showing, you know, the percentages of our active members who are in these different account types. And you can see our largest group there on the bottom, TRS 3, 45% of our active members are in TRS 3. But you can see now that TRS 4, up there on the left, is now the second largest group. 22% of our active members are in TRS 4. Again, no sick leave as salary credit, no annual compensation applied for retirement, just as no annual compensation for TRS 3 either. TRS 2 is now our second largest account type with 19% of our active membership. And TRS 1 is down to 14% of our active membership. And, you know, over the years, you're going to continue to see TRS 4 every year get larger and larger. And in just a few years, it'll be half our field of active membership. But it's just interesting to see this because these are really different account types. And particularly, you know, 4 from 1, 2, and 3 is a huge difference. And I just mentioned some of the highlights, that there are much more significant things about TRS 4 than I just now discussed, including eliminating exposure to unfunded liability risk for the Commonwealth and placing that instead on the members themselves.
But what was the percentage you paid on the supplemental account this year?
It's the percentage. It's 2% employer and 2% member.
Yeah, but then they're based on the returns that there's a different additional amount added to that, or is it just a flat 2%?
It's just the flat 2% as a mandatory contribution by the member and the employer. There's a provision in the plan document calls for additional voluntary contributions if the member would like to make those, or if the employer would like to make some additional voluntary contributions to the supplemental, which is kind of the savings account component of TRS 4.
Okay. Back on the trends, 10-year state employer contribution trends. That slide under retirement annuity trust, you have the state and the employers, but notice down toward the bottom, 25 on, the employer contribution rate drops, you know, from 102 to 94 to 85, and then 80. Those other years.
I think I'm on the wrong slide. This one?
Yeah, that's it.
Okay.
The employer contribution, you see it drops down those last 3 years to 80, while the state contribution continues to increase. We're not picking up some of the federal money that's disappeared there, are we? Is it being shifted to the state to play?
The state contribution is projected to increase, you know, anyway. I mean, that's what the projections have shown for years. So we're in line with that. I think right now with the federally funded positions, we're still kind of assessing that. I think what you see here is just some very conservative approaches of like, what if, you know? And I think at this stage, really, it's a little early, you know, to say with certainty what we're going to see with maybe what we're seeing on those federally funded positions. And again, I think that's primarily the reason you're seeing the decrease in those employer contributions, but I'll confirm that.
Okay. One other question real quick. The hour is late. On the health insurance, cash flow update on health insurance, the increase benefit payments for sick, I guess in the outflow, it was up $44 million from this year's $344 million. fiscal year 2024 was 300,300,000. That's a fairly significant increase in 1 year for benefit payments.
Yeah, so that can be a function of two things. That can be a function in number of people who are, enrolled, in the TRS plan. There are two plans. There's a Kentucky Employees Health Plan for our retirees under 65, and there's a Medicare eligible health plan for our retirees 65 and over. I think those numbers of participants are fairly steady, so that's probably not it. That could be attributable to an increase in cost. There's been some increases in KEHP premiums. Might explain some of that. Not really any significant increase. MEHP side, the medical eligible healthcare side, has stayed pretty consistent. We're at $210 per member per month now, and we hope to hold that steady. We just did an RFP, and we've awarded our administrator for our 65 and over Medicare eligible health plan, a new administrator for that. And as part of that, we anticipate that we're going to hold that at 210. So we're seeing that pretty steady. So might be seeing something on the KEHP side, maybe a little increase in utilization members enrolling in TRS healthcare, but I don't know. I can double check.
One last question, and we talked about sick days and annual leave. Recent superintendent retired. It was paid $350,000 a year through an open records request. That person retired with 100 annual leave days and 332 sick days, and so there's, I guess that was part of what I was saying earlier. It's not because they're working longer, it's because, well, that's a 30-year employee had 332 sick days. But we can't see what the retirement payment is to these individuals. But just doing a layman's guesstimate, that person would get about $22,000 a month, and from their salary only retirement, and about $5,800 a month from the supplemental from what the $268,000 that they got from their annual leave and sick days.
I will add one caveat. And I don't have any of these numbers or know if it's individual or anything, but in that scenario, I will note for highly compensated individuals, there are federal law limitations on how much of their compensation may be applied for retirement purposes, and there's not a fixed number on that. It's a sliding scale depending on what age they are when they retire. So we do have individuals, and this is just a caveat in doing calculations on the back envelope. There is a federal limitation that comes into play, and it is applied to our more highly compensated individuals. And then also there's some state law limitations that every year somebody has an issue where they've gotten salary increases that exceed what's permitted under our state statute, and we are limiting compensation. So there are, just to let this body know that there are federal and state law limitations on compensation that may be applied for retirement.
Okay, but
not saying that applies to your hypothetical at all.
But and the point I was getting to, that's if you the $268,000, if you take the 1.71% that you say is contributed for Social Security, or not for Social Security, but for COLA, that would produce about $63,000, and that well, I'm wrong on that. But anyway, I guess the point I was going to make is that it was $4,600 that would produce, and 1.5% COLA each year on the 63,000 that this individual would draw just from the service credit and sick days. That money generated by the 1.71% that you're setting aside for COLAs, that would only last about 5 years. And after that, that's strictly an unfunded liability. The COLA on sick days is always going to be an unfunded liability because, they don't work. That money doesn't have time to accumulate and work over the years. If they were paying that from day one when they were hired, like their retirement money does, the money they put into, the state puts in and they put in, that compound interest builds up over the years, and that's how we pay them back. But when you pay out that lump sum at the end, that money's never had an opportunity to work. So I guess that was the point that I'm making, that that money paid on the annual leave, or not the annual leave, the annual leave and the sick days creates an unfunded liability. Would you agree on that?
We're getting the normal cost for that, and you're talking about an individual account there. It sounds like.
I said annual leave at the normal cost.
So what I'll say is this, TRS is a pension fund. In some ways, it's like an insurance fund, company. It's an actuarial reserve pool. So we request contributions. We try to get investment returns that are going to meet what we need to pay at the end of the day for our group, covered group, just like an insurance company will with its auto insurance, home insurance, or life insurance. You're going to have some cases that you're going to have, somebody get homeowners insurance, their house gets hit by a hurricane the next day, or and then they have a fire. You're going to have, not every single insured is going to be a positive experience for the insurance company. And so same way it kind of works for the pension fund, you want overall that group mortality that we know they're going to live to on average, numbers we're seeing retire at, their salaries they're going to earn, that we are getting money in and investing enough and putting enough aside with the investments so that we can pay for that amount as a group. But an individual account, as the chair pointed out, that can be more costly than another account, just depending on individual, circumstances. But
Senator Nemus has a question.
Thank you, Mr. Chairman.
Final question of the day.
And Bo, what you just said is exactly right, but you danced around what Senator Higdon really meant.
Okay, and I didn't mean to do that.
Yeah, I know you didn't. You answered properly. But I'm going to make his point. He was saying an individual that is using the days at the end, we have not allotted for that, and it hasn't had a chance to compound interest. You're saying that the whole tries to accommodate for that so that you get enough money from the whole to accommodate for even those individuals that, and you kind of explained it earlier, where if I have a lot of in the insurance and I have a lot of claims, you're trying to say that you're taking the whole to cover for that. That's what I think Senator Higdon was saying in plain man's language.
Thank you.
And our time is up. Any further questions? I know I said that was the last one, but I guess the next thing, someone will make a motion to adjourn.